According to professional analysts, Nio stock will grow in the next 5 years. Despite their recent drop in stock price, they are a fundamentally sound company with good financials, and analysts are advising investors to be patient. In the past 6 months, Nio stock has lost 50% of its market cap. At the time of making this video, their stock is trading at $10.70, and they are bound to grow. Even though their stock price has fallen and investors are worried, the technicals are no indication of how the company is really doing. To do that, we will have to look at the fundamentals. Due to messed up supply chains with their current crisis, the reappearance of COVID-19 patients in China, and the cutthroat competition in the EV market, Nio's stock took a deep dive. But when we look at the company's revenue growth, we will see that they are doing just fine. If you're wondering why investors would be hesitant to invest in Nio, let us explain. Nio's revenue has been growing, but it has been growing at a slow pace. Nio is still a new player in this market, and breaking into global markets is very difficult. Before the growth of the stock price of Nio was due, in the large part to the rapid growth in revenue. But since revenue growth has slowed down recently, investors started pulling their money back. In 2019, the car managed to produce and sell 20,565 vehicles. The next year, as if by sheer miracle, they doubled their production and made 43,728 EVs. 2021 was no different, and this time, their doubling brought their number of units produced to 91,429. But 2022 was a bit challenging. Look at the price to sales or P/S ratio. We can see that the stock is currently trading at $3.70. But if Nio continues its trend of doubling revenue every year, we think that its price will fall to reasonable levels. Even though at the moment, the company has weak sales growth, rated at 1 out of 99 by investors.com. They can still smash that like button just like you should if you haven't done so already. But no, in all seriousness, they can still make a comeback. The site also stated that its SMR rating, which takes profit margins, sales growth, and return on equity into account, is a D, and that's on a scale of A to E. November 10th proved to be the most disastrous month for the company. They had to report net losses in the third quarter. Despite their increase in sales, they lost 30 cents per share, which was worse than analysts initially thought. And all the while, revenue was up by 17% as they delivered more EVs. However, the company plans of delivering between 43,000 and 48,000 in the current quarter, which would be better than expected, given the problems with the supply chains due to COVID. The recent crisis caused problems for major companies, and it nearly wiped out the small guys. Nio was one of them. The price of making and delivering their vehicles went sky high, and this put a dent in their sales. The first half of 2022, Nio delivered only 50,827 vehicles, when they should have delivered those numbers in a single quarter, if they were to follow their previous growth. The third quarter was slightly better because Nio delivered 31,607 units, and if they are to follow their revenue growth trajectory in 2022, they will need to deliver 58,334 electric vehicles in the last 2 months of 2022. After all, they only delivered 10,059 units in October. This seems unlikely, and stock investors know it, but they might want to wait a while before selling their stock. Why? Because the company is rolling out its new models, and they are trying to conquer new markets. Recently, the company launched and delivered its first ET7s, Nio's luxury sedan that's priced competitively with the cars from its competitors. Also, in June of this year, they launched their electric SUVs with 5 seats. They're calling it the ES7, and it has been expected to start delivering them in August. With a little delay, the cars made it to the European market, Norway to be precise, in October of this year. They are also planning on refurbishing their ES6, ES8, and their EC6 models in 2023. They are constantly growing overseas and in Europe, where they are leasing their cars to consumers. They are expected to spread across 25 countries in just 3 short years. Despite the problems it has encountered so far, the company is trying to grow as fast as possible. Forecasters expect their deliveries to grow until the end of the year. With Beijing relaxing its zero-COVID policies, Nio manufacturing plants are starting to open up. For example, Nio had to shut down its factories in Hefei because of the lockdowns. This happened on November 11th. Just one day prior, Nio posted that they took a loss in the third quarter of 2022, which was worse than expected. This was the main reason investors started selling their stock, and the price dropped significantly. The cost of production increased. The delivery of the vehicles increased as well, and Nio has been plunging a lot of its liquid assets into developing new models. In the fourth quarter, they smashed that subscribe button just like you should if you haven't done so already. But no, seriously now, they actually said that they will continue with their revenue growth. But if October is any indication, we don't know if this will be the case for November and December. And they already have a growth strategy in place. So far, Nio has been focusing on the premium EV market. Their car prices have been placed on nearly the same level as those offered by Tesla. But now, things are about to change. They are planning to go for the mass market, and they will start making new, affordable models of their vehicles that are high quality, but offered at prices that are more acceptable to the general public. Predictions are pretty bad at the moment. FactSet said that their earnings will double by the end of 2022, and revenue will jump 32%. In 2023, Nio will lose about 45 cents per share, all while revenue grows another 87%. Despite all of this, out of the 37 analysts covering the stock, 34 of them say that it's a buy right now, as the company will grow in the long run. And why is that? Well, unlike some of the other companies out there, Nio has tactical advantages that will set it apart. We all know that the Chinese EV market is very competitive, but none of them seem to be doing what Nio is. Unlike other manufacturers that have the battery built into the bottom of the car, Nio changed this. They offer their battery separately, allowing their users to buy the cars cheaper and then rent out the batteries for a monthly fee. One big problem in the EV market is charging, specifically charging on the road. Despite being more durable than the competition, Nio owners can now use battery swap stations. Instead of waiting for your car to charge, you drive up to the charging station. The AI of the car will realize that it's close to a charging station and will take over. Not only will it automatically park itself, but you will also get a fully charged battery placed on your car in less than 5 minutes. The goal of Nio is to build these stations across Europe and, together with other manufacturers, conquer the Asian and European markets, beating out Tesla in the process. So, you see, Nio knows that it can't defeat Tesla in the US, but that doesn't mean they can't go to Europe. And by the looks of things, they are doing just fine right now. In short, the company's current stock price is expected to increase in the future, assuming the company stays on this trajectory. Check out these videos next.